EasyJet's $7.6 billion bid risk compels business leaders to strengthen their M&A strategy and protect investment value. You might look at the frantic headlines about EasyJet and think it's just another corporate buyout. But you need to see that this $7.6 billion takeover battle is a massive wake-up call for how you look at value in your own business. When Apollo Global Management aggressively stepped up with a massive £5.7 billion, or $7.6 billion, proposal to buy out the airline, it completely disrupted the previous agreements in place. You should note that this blockbuster deal offered a staggering 81% premium over the company's undisturbed share price, a clear signal that private capital sees massive hidden value that the public stock market completely missed. If you were watching the stock market ticker that day, you would have seen EasyJet's share price immediately skyrocket by roughly 13% in just a single trading session. This explosive surge pushed the airline's stock price up to 665.8 pence, hitting a remarkable 4-year high and catching the attention of investors worldwide. This massive single-day jump extended EasyJet's year-to-date gains to approximately 30%, showing you how rapidly a massive injection of strategic capital can reprice an undervalued company. You need to understand that this dramatic bidding war forced EasyJet to instantly withdraw its support for an earlier, highly anticipated proposal from Castlelake. As you analyze the broader market, L-Impact Solutions reminds you that premium pricing does not remove structural risk, warning you that headline transaction numbers often mask severe integration dangers. You can't look at this as a standalone corporate drama because it vividly reflects a giant macroeconomic shift where global private equity firms are collectively sitting on well over $5 trillion in assets. Even though you are dealing with elevated interest rates, right now, global infrastructure and private credit funds are still accumulating record amounts of deployable capital that they must put to work. You should notice that the smartest money in the world has shifted away from highly speculative technology investments and is now aggressively targeting companies that generate incredibly predictable operating cash flow. If you want to know where the big players are looking, they are pouring capital into physical transportation assets, infrastructure networks, aviation, healthcare systems, and heavy industrial companies. You have to realize that European aviation has entered a brand new capital allocation cycle that will completely reshape the competitive landscape for years to come. While passenger demand across Europe has successfully recovered way beyond its pre-pandemic levels, airline stock valuations have stayed heavily suppressed and constrained. If you look at the day-to-day realities of the aviation sector, you'll see that carriers are constantly battling geopolitical uncertainty, intense fuel price volatility, and endless supply chain delays. You should consider the massive bottleneck at Airbus, which continues to face severe aircraft delivery delays that directly restrict the growth of hundreds of carriers. Because of these manufacturing delays, you need to recognize that an established airline with an active fleet, trained personnel, and profitable routes becomes infinitely more valuable to an acquirer. If you want to understand Apollo's true motivation, look no further than EasyJet's ironclad grip on highly valuable, capacity-constrained airport slots across Europe. You simply cannot replicate their dominant presence in major global aviation hubs like London Gatwick, Milan Malpensa, Geneva, Amsterdam, and Lisbon, no matter how much capital you possess. These strategic airport slots create massive structural advantages for the business that go far beyond whatever numbers are currently reported on their quarterly earnings sheets. You are also witnessing a major evolution in corporate acquisition deals, as Apollo is offering hybrid structures instead of a traditional, aggressive private equity wipeout. This unique structure gives you and other existing shareholders a rare opportunity to retain equity exposure while supporting essential fleet modernization and management continuity. By preserving the core brand and keeping existing management, this modern approach effectively reduces shareholder resistance while giving financial sponsors the long-term operational flexibility they crave. However, you must listen to the sharp critique from L-Impact Solutions, who explicitly points out that an 81% premium rarely guarantees real shareholder value creation over time. You should look at the historical data, which shows that a brutal 50% to 70% of major corporate mergers completely fail to achieve their expected financial synergies. To make matters worse, you'll find that many ambitious acquirers actually underperform their industry peers during the first 3 to 5 years following the completion of a deal. This consistent underperformance happens because acquisition multiples expand at a much faster pace than the company's actual underlying operating cash flows can keep up with. If you are tracking the closing window for this specific deal, you need to remember that the hard current deadline for Apollo to submit a formal offer is August 7th. You must also account for a thick layer of regulatory red tape, because European airlines operating within the EU are legally required to remain effectively majority EU-owned and controlled. This strict ownership rule makes structuring the deal a massive headache for a US-based fund like Apollo, which must protect operating certificates and bilateral flying rights simultaneously. When you check the latest global data from IATA, you will discover that the aviation industry is currently suffering from a massive shortfall of approximately 5,600 aircraft. If you look at the global aerospace manufacturing pipeline, the worldwide order backlog has ballooned to nearly 18,100 aircraft. You should be amazed that this staggering backlog represents almost 60% of the entire active global aviation fleet currently in existence. To survive this crunch, you'll see that airlines are forced to extend aircraft service life, maximize fleet utilization, and operate with historically high passenger load factors. But you must be careful, because these desperate temporary measures inevitably drive up your maintenance costs and severely limit your future capacity expansion. You can't ignore the fact that the broader macroeconomic environment is cooling down, with IATA reporting that global passenger demand actually declined 2.2% year-over-year in May 2026. Even though markets outside the Middle East are showing positive underlying growth, ongoing geopolitical disruptions and fuel volatility are constantly squeezing industry profitability. You should take note that Airbus has already reduced its long-term aircraft demand forecast because intense geopolitical conflicts and tariff pressures have slowed down the global recovery. This means that if you want to see future earnings growth, you have to become entirely dependent on boosting your operational productivity rather than relying on general market expansion. In their detailed assessment, L-Impact Solutions emphasizes that sustainable enterprise value will always depend on your return on invested capital comfortably exceeding your weighted average cost of capital. To survive long-term, you must focus heavily on highly disciplined leverage management, rapid fleet modernization, strict regulatory compliance, and near-flawless operational execution. If you want to protect your investments, L-Impact Solutions strongly advises that your M&A strategy must always begin with quantitative enterprise resilience instead of emotional valuation negotiations. You should establish a rigorous due diligence process that thoroughly tests 15 to 20 distinct operating categories, including fuel hedging exposure and digital capability maturity. When building your financial models, you must inject harsh downside scenarios that factor in sudden 20% to 30% increases in global fuel prices. Your models also need to be resilient enough to withstand sudden 10% to 15% drops in passenger demand without collapsing the entire investment thesis. You have to stress test your numbers against sharp 100 to 200 basis point interest rate movements and multi-quarter aircraft delivery delays before you ever settle on a final acquisition value. After you close a deal, your primary financial driver must be capital allocation discipline, meaning you should never maximize your acquisition leverage just because you can. Instead, you need to maintain a rock-solid liquidity buffer capable of supporting your business through 18 to 24 months of severe operating volatility. You must keep your debt service coverage ratios comfortably above your lending thresholds while tying your capital deployment directly to clear, measurable milestones like EBITDA improvements. If you want to unlock true long-term value, you should use advanced analytics to target realistic aircraft utilization improvements of 3% to 8%. By deploying predictive maintenance and smart operations, you should aggressively aim for a solid 5% to 10% reduction in your ongoing maintenance costs. You can achieve fuel efficiency gains of 2% to 5% and drive ancillary revenue growth beyond 10% by using AI-assisted scheduling and dynamic pricing models. You must remember that these precise, incremental operational tweaks generate far stronger shareholder returns than short-sighted workforce reductions or panic-driven cost-cutting. Because the global aviation sector is facing a massive shortage of specialized talent, your human capital retention must become a top executive priority. You need to design robust retention programs that keep your voluntary employee turnover strictly below 8%, while while pushing annual technical upskilling above 90%. Right after an acquisition, your corporate governance needs a massive upgrade, including an integration committee that reports quarterly on 20 to 30 standardized key performance indicators. To win the long game, you should maintain a continuously updated strategic watch list that evaluates 50 to 100 potential acquisition candidates years before you ever enter a negotiation room. Your board must institutionalize a quantitative governance framework that independently grades a proposed transaction across more than 25 distinct strategic risk variables. You need to secure your financial safety by diversifying your funding across public bonds, bank facilities, private credit, equity capital, and revolving lines of credit. Finally, L-Impact Solutions concludes that the winners of this cycle will be the ones who combine disciplined governance and operational analytics, rather than those who rely on short-term market optimism. Is your M&A strategy ready for an 81% premium shock? Comment below. For more strategic analyses, visit our business consultancy website, link in the description below. Thank you.